Hi, I'm Michael Leland.
Hi, I'm Matt Schubert.
Good to see you, Matt. Today we're going to talk about how to start a financial plan, which can be certainly very intimidating for a lot of folks. What would you say is the first step that folks should take to get that rolling, Matt?
Yeah, there's definitely a lot of information out there on financial planning and personal finance in general, so I can see how that can be overwhelming for a lot of people. The first step we usually do with clients is just really organizing and gathering all their financial data and putting together a list of all of your different financial accounts. So what we do first is we kind of gather all your assets, which is anything that has financial value, such as checking accounts, your home, autos, anything like that. And then putting those together in a list, and then your liabilities in a list as well. So liabilities would be like credit card debt or your mortgage, other loans, anything like that. So first step, we kind of just organize, get everything in one place, and then kind of get a high level picture of where you're at financially, your net worth, kind of your personal balance sheet. That's the starting point with our group.
So once somebody has that in place, they know their assets, they know their liabilities, they know where they stand. What next? What's the next logical step?
Yeah. From there, now that we have a kind of a current snapshot of where we are financially, the next step is really figuring out, okay, where do we want to go from here? What are our financial goals? So just getting really clear on goals, setting timelines, specific amounts, kind of like the due dates, really getting as specific as possible with all of our financial goals, and then prioritizing those goals into a list of what are your top goals, and kind of moving down from there. So we really want to see, okay, right now we're here, where do we want to go, and then we can kind of figure out the in between of what we need to do to get to that point.
And as somebody who's worked with a ton of clients over the years around this type of stuff, what would you say are some of the most common goals that you see folks having?
Yeah, everyone's financial situation is different. Obviously, we all have different financial goals, but the first step we always start out with, if someone's just getting started, is really creating an emergency fund. So this is money that's set aside for unexpected events. So this would be you lost your job, or you had a medical emergency that you weren't expecting, anything like that, a car breakdown. Those would be things you would want to be prepared for and be able to handle financially. So that's kind of number one step, is setting up that emergency fund to make sure we're prepared for a potential unexpected situation.
So, two-part question to follow up with that. One is approximately how much money should somebody have in an emergency fund? And then two, is there a specific type of an account that would be most helpful to put that money into?
Yeah. So the typical recommendation for emergency funds are 3 to 6 months of expenses saved. So whatever your typical monthly expenses are, having 3 to 6 months of that saved up. But this is definitely going to vary depending on the person. So, for example, let's say you have a spouse who also works, that'll affect how much you need in your emergency fund. If you have another income, you might not necessarily need as much in the emergency fund, since you can be supported by that other income. On the opposite end of the spectrum would be, let's say you are self-employed, or you have very variable income. For example, you make commission, or your income tends to fluctuate each month. In those situations, we typically recommend having more than 6 months, just because there's a lot of uncertainty with your paycheck for that type of career. And so we want to have an extra cushion there. But again, this will all come down to personal preference. If your comfort level of having only 6 months saved up doesn't help you sleep at night, then you might want to have more in there. I don't think there's any real downside to having more than 6 months in your emergency fund. So there's definitely some individuality there. But and then answer your second question on the type of account. So there's a couple different things we recommend. Obviously, with this money, we're planning to use it for emergencies only, and so we want to make sure this money is in a secure place where there's no risk of loss or anything like that. So we don't want to be investing this money in stocks or bonds or anything like that. So we either typically recommend having it in a high yield savings account, which is very similar to a traditional savings account, but generally has a higher interest rate. So you can actually get a little return on your money while it's sitting there prepared for the hopefully never happening unexpected event. But and then the other suggestion is either having it in their high yield savings or doing some sort of like laddered CD strategy. So like a money market account or a certificate of deposit. These are very short term, very low risk government securities that you can kind of put your money in that will also generate a little bit of return and allow you to make some return on your investment while it's sitting there safely.
All right. So step one for most folks, set up an emergency fund. Any next logical step from there?
Yeah, the next step we always want to try to address is if the client has any high interest debt. So we consider high interest debt to be anything above 8%. So that's kind of the threshold for us. We feel anything below that, we can generally do better investing in the market. So we really want to prioritize paying off that high interest debt because that can really affect us negatively and our financial situation as we accrue debt. The interest building up can kind of compound on itself and make it really tough to save money. So prioritizing that is kind of the next step after having that emergency fund set up.
And with that, I've heard different philosophies around how to pay off debt. I've heard about the snowball effect. I've heard pay down, the debt with the highest interest rate. Do you have any set strategy around that, or is that how does that work?
Typically, we recommend it's the debt avalanche strategy, which is basically paying off the highest interest rate first and working your way down that way. That's generally going to be the most efficient, allow you to pay the least amount of interest over time. But this will definitely come down to personal preference. So if there's a debt that you have that really stresses you out, you just really want to get rid of it, even if it's not the highest interest rate, but it makes it tough for you to sleep at night. That's something we would want to address sooner. The other situation, kind of related to that emotional aspect as well, is the debt snowball method, which you mentioned, which is tackling the lowest balance first. So let's say you have credit card debt, but it's only $1,000, and then you have something else that's higher interest, but it's $10,000. So it's going to take you a lot longer to pay off that $10,000 debt. So maybe you want to tackle the $1,000 first so that you can pay that off sooner, kind of get that emotional win, and then use the money that you've set aside to pay that off to really start snowballing and build towards the next larger debt. So kind of personal preference, but the most optimal strategy and the way to pay the least amount of interest would be tackling the high interest debt first.
What would you say to somebody who kind of sets out their financial goals, has some debt, looks at their income though, and realizes that some of these goals are going to be completely out of reach?
Very common situation. I don't want anyone to panic who's in that situation. I think a lot of people are going through that same thing. It's definitely very tough economically right now. So we definitely deal with a lot of clients in that same situation. But we really try to look at two sides of the equation. So there's obviously the expenses side, which I think is really brought up the most often, is trying to cut your expenses, live frugally, and really be able to save as much as you can, which definitely can help, and there is a benefit to that. But there's also the other side of the equation, which is the income side of it, which we think as consumers we have a lot more control over. So whether that be starting a business, investing in real estate, something that generates income for you, or just potentially getting a second job, not the most sustainable thing, but if you're really in a tight situation and you need to find something, getting a second job, or especially these gig economy jobs now that have a lot of flexibility, offers a way to quickly make some income on the side without having to take on too much. You can always kind of choose your own schedule. So that's something we definitely recommend if you're in a really tight situation and kind of looking for anything you can do to really get out of that situation.
So I appreciate you walking us through all of this kind of do-it-yourself tactics and strategies. What would you say, though, to somebody who says, that all sounds great, I don't feel comfortable doing it myself, I want to work with a financial professional, whether that's a certified financial planner, somebody in your industry? Yeah, how would you direct somebody who wants to get professional help?
Yeah, I mean, I definitely think it's going to come down to your individual situation, whether or not you think you need help. There definitely are benefits to working with someone, especially from an accountability perspective. I think that's one of the biggest benefits of working with someone else. You're meeting with them regularly, and they're kind of checking in with you to make sure you're staying on plan. But Yeah, the biggest recommendation I have for finding the right person to work with is really knowing what you're looking for, the current situation you're in, and finding a financial planner who works directly with that exact type of client. So whether that be, you're a real estate investor and you own a lot of properties, finding a financial planner who works with other real estate investor clients, or a financial planner who focuses on business owners. I think, there's a lot of different areas and aspects of finance. So finding a financial planner who really specializes in your specific situation, I think that's the number one thing I would look for, just to make sure that they really understand, they've seen this situation a lot, and so they know how to work with your situation, and they have a lot of experience in that area.
And if somebody wanted to reach out to you and get in touch with you, what's the best way to make that happen?
Yeah, so if people want to reach out to us, the typical financial planner often has minimum investable assets that they require to work with them. Their fees are generally on the higher end. So that's kind of what the purpose and how our company started, Planned. We've built a financial planning app that kind of allows users to create their own personalized financial plan, get assigned tasks, personalize their situation, and work with a financial planner at a much lower cost. So that's kind of where we come in. We really focus on clients that are earlier in their stages of their financial lives. So that's kind of what we try to prioritize and help out with. We felt that that market was kind of being overlooked by a lot of the financial planning industry. So yeah, if you have any questions, definitely check out our website. Or if you want to learn more, our website is getitplanned.com. We can leave a link somewhere for people to access. Or if you want to email me directly, my email is matt@getitplanned.com.
Awesome. Thanks so much, Matt.
Yeah, thanks for having me.
And if anybody has any questions about real estate financing or the real estate market in general, you can reach me at michael@mortgage-trust.com.